Hello and welcome to Forex.Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing Forex options and risk profiles of the basic put-call strategies. A risk profile is the most important tool for analyzing the gain-loss potential of an option strategy. Thus, we need to dedicate a chapter to understand how to make risk profiles. This is because understanding and managing risk is a critical task for the options trader. Risk profile. A risk profile is the graphical representation of the profit-loss of an options trade in relation to the changes in price of the underlying asset. The horizontal axis shows the possible stock prices of the underlying asset. The vertical axis from bottom to top show the potential losses and profits. The graph lines indicated the theoretical profit and loss of a potential expiration. The zero line is the trader's break-even point. To create a risk profile of a call option, the horizontal line below the zero line would represent the cost of the option at day zero, since below the strike price the option has no intrinsic value. The horizontal line shows the time value. This line is extended until the strike price point. From there, profits begin to add up, so the path heads to the upside with a slope that reflects the profit and price change. Take a look at this Euro-USD September call. An easy way to construct it is by using Excel's graphs after creating a table with relevant profit and loss points. As an example, we present a long position on the Euro-USD. In a long call position, we buy the right but not the obligation to purchase the asset at the strike price. Thus, if the asset drops in price, let's say to 1.0, we are not obligated to buy at the 1.1850 strike price. This sets the maximum loss to the price paid for the call option, which is $144. Therefore, if we set the cost value to minus $144 with the minus sign from 1.0 to its 1.1850 strike price, that will draw a horizontal line. Then we compute the break-even price of 1.1944 and set its profit to 0. We calculate the distance from strike price to break-even. We can then add points which will also show $144 profit differences. After creating the table, we can create a graph and display it on the sheet. In the case of an option seller, he expects the price not to go above the strike price at expiration, but our maximum profit is the option premium of $144. If the price moves above the strike price, his premium will fade and start becoming an increasing loss. That is reflected in the profile. As for puts, the Euro-USD 1.1850 long put profile is shown below. When we purchase a put, we buy the right to sell at the strike price. Thus, we expect the price of the asset to drop, but we don't have an obligation to do it. So if the asset's price moves up, our loss will only be the cost of the put option, $133 in this case. That creates the profit-loss profile shown above. The short version of the Euro-USD September put, when you sell the option instead of purchasing it, is in this case the maximum profits occur when the price at expiration is above the strike price. Prices below expiration will convert that profit into an increasing loss. These kind of graphs will give you the basic profile in case you do not have more sophisticated means, such as analytical software to determine the profile curves. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.